Okay, good evening and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to do a review of everything we've learned over the past few weeks as far as how to utilize debit and credit spreads. Now, the format of our education here is always going to be where we spend time learning specific topics like credit and debit spreads like we have over the past few weeks. And before we move on to the next topic and start learning about new topics, we always want to take a second to pause and revisit what we've learned and make sure that, number one, that we understand the content. More importantly, we also know how to apply what we've learned to the real market. So today, our session, we're not going to necessarily learn anything new. What we're going to do is we're going to spend the time to take what we've learned and apply them to looking at the real markets together, looking at some symbols that I've pulled together, and show you how I would utilize the current market conditions to determine whether I might want to trade a debit spread on a stock or index that I have a directional view on, how I would trade a credit spread, and then also giving you guys the opportunities to submit the symbols that you want us to look at together. And we'll look at those symbols together and put them into the context of talking about trading debit and vertical spreads. So let's go ahead and get started here. Now, before I do, can everyone please bring up your chat window, which is at the bottom of your window? And just please type yes if you can hear me loud and clear. If you can hear me on that chat window, great. Okay, so let's go ahead and get started here. Now, the first thing I want to discuss is just a quick disclaimer that what we're going to discuss here is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. We're going to go over quite a bit today, but predominantly what we're going to start off with is talking a little bit about where the current market stands and what option strategies that we feel are suitable for the current market condition. And what we're going to do is we're going to do a quick review of debit and credit spreads. Those are the two topics that we discussed in the past 2 weeks where we did education. So before I move on, how many of you were able to join me for either the debit vertical spreads or the credit vertical spreads? Please type yes if you were able to join us for those sessions, and please type no if you were not able to join us for those specific sessions. Okay, I see a lot of yeses. I see one no. If you missed one or if you missed both of them, we will make sure that we show you how to access those recordings. They are all available to you on your education page. So you can sign up, you can go to the education page, which I will post into the chat window right now. You can go to the education session, which we have our educational courses under. You can click on that and that will give you access to all of our previously recorded courses. So we have debit vertical spreads, credit vertical spreads, and today we're doing the live market analysis. So you can always go to this page to get access to previously recorded webinars. So we're going to go through some concepts that we discussed during those two sessions. If you missed them, I highly recommend you to go back and make sure that you watch those recordings before you might want to review this one, just so you make sure you understand everything that we learned during those sessions, and so that you have access to those educational sessions as well. Okay, so we're going to go over those two, a quick review. Then what we'll do is a very quick market analysis of where the market currently is trading, and then at the end we will answer any questions or answers at the very end. So let's go ahead and get started here. One of the questions that I want to try to start answering, or one of the questions I want to make sure that everyone walks away from this webinar having a good answer to, is really along the lines of the questions that we've been getting a lot as strategists over the past couple of weeks, which is, can the markets continue to rally despite this resurgence in COVID-19 cases we've seen globally? We've seen this in countries that, in theory, flattened the curve, started to reopen, now started to see a consistent spike in terms of activity. We're seeing this across developed nations. We're certainly seeing this across a lot of the developing and emerging markets. More of a first wave in many of those countries, but some of them being fairly out of control right now in Latin America. Even in the US, we've seen a significant spike in cases in certain places that have reopened up early. So we want to discuss, can markets continue to rally? Because We certainly had a bit of a pause here over the past few weeks, but markets over the past couple of days have started to resume its somewhat bullish stance, if you will. There certainly is a bit of strength that has come back into the markets. And the question is really, how much strength can we possibly see? So those are some of the answers that we want to try to answer. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. For those of you that don't know who I am, my background heavily spans in currency trading. So for those of you that trade currencies, you might be familiar that as you trade currencies, you predominantly use the charts to make your decisions as to what's your directional view. And I leverage the charts very heavily in helping me better understand where a stock or asset or index may be headed next, and where do I want to get the best setups utilizing options. So today what we're going to do is we're going to give you a walkthrough of how I look at the markets, how I set up my trades in the context of debit and vertical spreads, and show you how I would potentially trade it. And then open this up for Q&A so that you guys can submit your symbols, you guys can submit your questions, and we'll go over all of those things together. So let's go ahead and get started. Now, the debit spread side, this is what we learned 2 weeks ago. This is what we learned here in mid-June, where we talked about how you can turn a long call or a long put, meaning either a simple bullish or a simple bear strategy, and how can you turn it into a strategy that risks less and increases your probability of profit on that specific trade. And that's by trading a debit vertical spread, because a debit vertical spread, what you're doing is you're still trading a call option. You're buying a call option, which gives you unlimited gains while capping your losses to the downside. So if the stock goes higher, you make more and more money the higher the stock goes. But if the stock goes lower, no matter how low it goes, you're only risking a certain amount of capital. That certain amount of capital depends on how much you have to pay for that call option. And that's the biggest challenge of buying a call option, is how much the call option costs. And that's how much the stock needs to move by before you can start making a profit on that specific trade. Now, the challenge here is the fact that you have to pay that amount, and that amount, if it's a relatively high amount, requires the stock to make a big move to the upside just for you to break even. So one of the ways to offset that is to buy a call option, but at the same time sell a higher call option so that you're bringing in enough of a credit to reduce the cost of the trade, which reduces the risk of the overall trade. It reduces the amount of capital that requires for you to place the trade. It decreases the break-even price so that it increases your probability of profit. And the only trade-off that you're making here is that at some point, the strategy will no longer make more and more money if the stock continues to go higher and higher and higher. Now, that's the challenge when you're trading a debit spread, is really choosing the strike price at which that you choose to sell. And one of the things that we discuss is how to select that strike price and how OptionsPlay automates that process for you. This is designed from the ground up to increase this is really designed from the ground up to increase your potential rewards by decreasing your risk. And this is something that we discussed at length over the past few months regarding risk management and how to manage your trading accounts, because as traders, we can't control how much money we can make. We certainly cannot control where the markets go, but we can control how much risk we take. If we are able to take every single trade with a smaller amount of risk, what that does is it amplifies our returns when we are correct on the overall direction of the market or the overall direction of the underlying stock that we're trading. So it's important that we take a look at that when we're trading our markets and making sure that we're doing everything we can to reduce our risk exposure. And debit spreads is one of the greatest ways, in my opinion, to learn how to reduce your risk exposure when you're trading an option strategy. Because this is just the first step that you take to learning more about how to construct different option strategies together to give you the payoff that you're looking for, and more importantly, reduce the risk that you actually have or reduce the exposure that you have on any given trade. So debit spreads, I think, in my opinion, is the first complex strategy that most investors should learn on their journey to learn more complex strategies, because every other complex strategy and options build on this concept, this fundamental building block of how do you combine strategies together to give you the payoff graph that you're looking for, which in this particular case is profits if the stock rises, but do so in a way where you're risking the least amount of capital possible, which means that if you are correct, that you get the highest possible return. So that's really what we explored 2 weeks ago, is using debit spreads for whether either a bullish or bearish view on an underlying stock, and how to take that bullish or bearish view when you expect that stock to make a relatively sizable move, either higher or lower, how to do that with the least amount of risk. And that's what we discussed using debit spreads. Then last week, what we discussed is a different strategy, which is selling credit spreads. So this, again, builds on our basic foundation of the fact that when you're trading options, there are 4 strategies. You can buy a call, you can buy a put. Those are the first 2 strategies you've learned. And what we learned during the debit spreads is how to improve buying a call and buying a put by a little bit by reducing risk. The other 2 strategies are selling a call and selling a put. Now, selling a call and selling a put, those 2 strategies are not strategies for beginners, because those are both strategies that require, or rather, selling a call option naked is not a beginner strategy. Selling a put option to acquire the stock is a beginner strategy, but it is a strategy specifically for acquiring the stock. If, let's say, you want to take a bet where you don't want to own the stock, then selling a call and selling a put on margin is not a strategy that's suitable for most beginners. However, what you can do is you can make a slight modification to those 2 strategies and make it a strategy that anyone can trade, which is selling the call or put and buying back a lower call or put against it to reduce the risk of a trade. And that's what we covered during credit spreads, because if, let's say, OMX S30 is trading around 1660 and you think that the OMX S30 is going to move a little higher, a little lower, but you weren't sure that it's going to make a big move higher or a big move lower, you just thought that it was just going to move roughly sideways, then the best way to play that is by selling a call or a put. But the problem with selling a call or a put is that when you do this, you're taking on with unlimited risk. And that's not a strategy that we ever recommend a beginner to trade. Anything with unlimited risk, even if you're an advanced trader, I generally don't recommend to trade, because you never want to expose yourself to unlimited risk. But there is a simple modification that you can do where you can still sell the put, but then buy back another put against it to reduce your risk or cap your risk, so that no matter what happens, you have a set amount of a max risk. And whenever you're able to reduce your risk, again, that's when we're able to amplify our returns. So this is what we learned during credit spreads, which is, again, building blocks off of the 4 fundamental option strategies that you can trade: debit spreads for buying calls and puts, credit spreads for selling calls and puts, and being able to do that without taking on unlimited risk. So a put credit spread, which is the bullish credit spread, allows you to sell a put and then buy back a lower put so that you have reduced risk to the downside. So if you're wrong and the index plummets, that you have limited exposure to the downside. And to the flip side, if, let's say, you thought that OMX S20 was going to move slightly lower, but not by much, right? And that's some of the environment that we might find ourselves right now in, where you think that the markets are in a bit of equilibrium and you think they're going to move a little bit in one direction or another, but you don't necessarily anticipate a huge move, because maybe there aren't any big catalysts that you expect would move the markets that much. So if you think that the market's going to make a slower move, what you can do is you can sell a call option. But when you sell a call option, you have unlimited risk. So you don't want to take on that risk, because if you're wrong and markets do take off, you can expose yourself to a lot of risk. So one of the ways that you can reduce that risk is by buying a higher call option. And by buying that call option, what you're doing is you're reducing your max risk from unlimited to a certain amount. So those are the 4 strategies that we discussed over the past few weeks. If you caught those, if you were able to watch those recordings, this was just a quick review of those 4 strategies. If you're brand new or if you missed them, I highly recommend you to go back and watch the recordings using the links that I showed you. So what I want to do is I want to start off by talking a little bit about the overall market. I want to give you a brief overview of how I'm currently looking at the markets. And then what we'll do is we'll take a look at some option strategies for this particular market and see how we would potentially trade it. So I'll start off by taking a look at the OMX S30. Now, one of the things that you'll notice about the OMX S30 is off the rally, it had subsequent waves of buying and selling. We've now had roughly what we would consider 5 waves of buying. So for those of you that follow Elliott wave, we've completed what would be, what might be seen as a 5-wave buying pattern, or a up wave, if you will. And since then, what's happened is that this wave formation has stopped, because since the last pullback, it has not been able to rally past the previous high here around 1730, 1725 or so. It managed to rally back into the roughly 1700, 1690 range, and has roughly stalled here in this particular range. It is currently trading roughly sideways. So this is where the equilibrium and the market seems to have found a bit of a let's call it a triangle. There's different ways that you can look at this, but it's really just the markets effectively agreeing on a current price where there aren't an overwhelming number of buyers or an overwhelming number of sellers. You basically have a bit of a stalemate. And the question is right now as to whether markets are going to break out to the upside or they're going to break this triangle to the downside. Now, this is sometimes where we can turn a bit to the fundamentals and we look at, do the fundamentals support where the markets currently are trading? I think many investors feel that the markets, the economics and fundamentals do not support where the markets are trading. And I think there are a lot of investors that are betting and believing that the markets will sell off. And on the same token, if you look at the amount of liquidity that are being injected into the system by global central banks, you have more of a thesis that markets will continue to go higher, because you have trillions and trillions of dollars in liquidity, and they have to go somewhere. And right now, if you look at fixed income, if you look at government bonds, if you look at corporate bonds, the yields are very, very low, if not sometimes zero, sometimes potentially even negative. So many investors seeking yield, many investors seeking income are finding that really the only place that they're able to achieve that is in the equity markets, especially if you consider the volatility that we've seen in the fixed income markets. It may not justify the yields that you're currently getting in the fixed income markets. And that's one of the thesis and one of the reasons why equity markets continue to push higher despite the fundamentals and economics not lining up with that view. And this is one of the concerns that liquidity, that when central banks pump this much liquidity into the markets, these are the types of distortions that we see in markets that completely decouple from the economics and fundamentals of an underlying stock or an underlying index. So those are some of the ways that we're currently viewing the markets. So my view as a strategist in the broader global macro view is more along the lines of in the camp that markets can continue to move higher, especially given the fact that the coronavirus is nowhere close to being solved. Markets and governments around the world will likely continue to find different ways of fiscal and monetary policy to support their country and their markets to prevent collapse. We've seen it very much across developed markets, across China, across European markets, across US, North American markets. We see it in the Nordic region as well. A little less so in some of the other developing nations, but they are still catching up from that perspective. So with all of that liquidity continuing to pump the market, it's difficult to fight that liquidity. It's difficult to fight that trend and bet that markets are going to fall. Now, if you are in the camp of you believe markets are going to head lower, make sure that you are very, I would say, diligent on staying on top of your short positions, because one of the things that you'll notice is that when you do have short opportunities like we had from this fall to here, they are very, very short-lived. They usually last no more than 3 to 5 trading sessions. Most of these sell-offs, they tend to be very quick, very violent. There isn't a lot of I would say, indication of when they're going to start, because many times you might have small movements. So you, over this period of time, right here on May 28th, markets looked severely overbought on the short term. You might have looked at that next bar and said that markets are going to correct lower, and what you get instead is a very quick move to the upside. And then you get that sell-off, and that sell-off lasts, again, just 3 to 5 trading periods, trading sessions, of which by which, if you did not get out at the very bottom, the very next bar opens up significantly higher up here, which means that you would have lost out on most of your gains on your short. So shorting this market, it's very, very difficult. Remember that if you're going to be trading this market. So just out of raise of hands, how many of you think that the markets can continue to move higher? Please type yes. And how many of you think that markets are going to start moving lower? Please type no. I just want to get a sense for the audience here in the room. Okay, so it seems like most of you are saying yes, but I also see quite a few no's. So the markets, again, have reached this bit of equilibrium, right? Where you have a lot of investors who feel markets can continue to move higher. And I certainly will say a growing number of investors who feel that markets are completely decoupled from fundamentals and they have to fall. The one warning that I have for those of you that are in that camp of believing that markets will reverse lower is be very careful, because statistics show us that when markets correct, they tend to be very fast, very violent. They don't last very long. Certainly don't, you don't get 30% moves in a month very often. You can get, 5 to 7% moves within a few trading sessions. But again, my warning to you is that you have to time these trades very, very quickly, because they tend to be very quick and violent, and they have very violent snapbacks that in a single trading session, you can give up all of your gains on that short position. So be very careful. So what I'm going to do is I'm going to take a look at the OMX S30, and I want to show you some debit versus credit spreads depending on your views here. So I will say that the markets have been in this kind of equilibrium state here for roughly 2 weeks or so. Now, generally speaking, when you have a consolidation range for this type of time, what you tend to generally get is breakouts either to the upside or potentially to the downside. So if you are in the belief that markets can continue to move higher, you might believe that things can move higher relatively quickly or relatively quickly to the downside. We'll explore both, okay? So let's look at the OMX S30. And let's say I'm bullish on OMX S30. So I can buy a call option, which we learned that if you bought a call option here on OMX S30, it would cost you roughly 67 crowns per share, if you will. An index consisting of 100 shares for a contract will cost you 6,750 crowns to buy an August 1670 call option. Now, 1670, let's take a look. 67 out of 1675 is roughly 4% of the underlying index value. So you're risking 4% of the underlying index value to take a bullish bet that OMX S30 will be above 1737, which is the break-even price of this strategy by the August expiration. Now, 1737 is roughly at that 52-week high. So you basically have to say to yourself, by August, I believe OMX 30 will have moved higher and made it to a new 52-week high a new relative high, a new 3-month high, in order for it to make sense for me to buy a call option. Now, what I want to show you here is the debit spread on the right-hand side. What we're still doing is buying the 1670 call, costing us 67.5 crowns. But what we're doing against that is we're selling an 1830 call against that and collecting 6.6 crowns, which reduces our cost from 6,700 crowns to roughly 6,000 crowns. So we're reducing it by about 10%. We're bringing in about 6 crowns of credit. It costs us 67 crowns. So by bringing in 6 crowns, we're reducing our risk by 10%. So what I want to show you is by reducing a risk by 10%, what does that look like? So first of all, whenever we're looking at options, I always tell investors that I know it's fun to explore how much money can you make. It's always interesting to look at, wow, how much potential does a trade have? But as an investor, what I always advocate for beginners or even experienced investors is don't look at how much money you can make first. Look at how much money can you lose and ask yourself, am I comfortable with that? Because if you're not comfortable with that, you shouldn't be looking at the trade to begin with, right? Everything should always stem from first, how much are you willing to risk? Because I seem to never get questions from investors asking me, how much money can I lose trading options? I always get questions, how much money can I make? But the problem here is that you can't control how much money you can make, but what you can control is how much money are you risking. So I always ask questions, when an investor asks me, how much money can I make from trading options? I always first ask you, how much money are you willing to risk? Are you willing to risk 10% of your account on a trade? Are you willing to risk 30% of your account on a trade? Are you willing to risk 100% of your account per trade? Because that's going to directly correlate to how much money can you make. So you have to first ask yourself, how comfortable am I risking 6,700 crowns or 6,000 crowns? If you're not comfortable risking 6,000 crowns on a trade, this is not a trade for you. You should look at other strategies. And there are other things that you can trade. You can trade the ETF on the OMX S30, which has a lower value. You can trade those if you're not comfortable risking 6,000 crowns. But first look at how much money are you risking, okay? So let's first take a look at this. So OMX S30 closed at 1675 today. Let's just say that we're wrong. Coronavirus cases continue to spike. The spiral's out of control. Governments go back into lockdown and markets start to fall. I think that that's not, it's not a high probability, but it's very probable that something like that could happen. So I always want to account for, let's just say markets revisit a worst case scenario. Let's say it goes down to 1,400. Let's say things that we cannot anticipate today happen next week, where things really get out of control and we want to know how much we're risking. So first of all, now we can't trade the index itself, but you can trade futures on the index. If you were to buy a future, you're looking at about a 27,000 crown loss if some kind of black swan event happens and the markets continue to fall precipitously as a result of the markets shutting down or governments shutting down. So 27,000 crowns, big loss there if you are traded the future. This is part of why we don't like to speculate using strategies that have symmetrical risk, because you are typically putting on quite a bit of risk. We much prefer strategies that have asymmetrical risk, so that if we're right, we can make money, and if we're wrong, we have limited risk. So here, if that happens, I'm only risking 6,700 crowns versus the strategy on the right, I'm only risking 6,000 crowns. So you should always look at what's your worst case scenario and ask yourself, am I comfortable with that risk? If you are, then we can take a look at, well, then how much money can I make? So now let's go back to the event. Well, let's just say the market moves mildly higher. It revisits that 1732 relative high that we put in back here on June 5th, at the beginning of June. If that happens, as you can see, if you have bought the future, you're looking about a 3% return, not a big return. If you bought the call option, you're actually looking at a loss. This is the biggest challenge of trading call options, is that you can get the direction correct and still lose money on the trade. And that's very counterintuitive for many investors to say, I got the direction correct. The index went 60 points in the direction that I expected to. That's not a small move, right? For the OMX S30 to move 60 points. We're talking about almost a 5% move in the direction you expect to, and you still lost money. That for a lot of investors is a big slap in the face, and is a wake-up call as that trading options is not suitable for everyone to be able to get the direction correct and still lose money. Now, the vertical spread, as you can see here, not much better, only a 1.8% return. So even in this particular case, even the debit spread does not in itself prevent you from losing and prevent you from having this trade not really be worth your while, because you certainly don't want to take on 6,000 crowns worth of risk to make 100 crowns. That's not the type of risk to reward ratio that anyone's looking for. So you really have to believe that OMX S30 is going to make a new relative high before it makes sense for you to be buying any options, whether you're buying a call option or a debit spread. And that's the power of this tool, because I see many investors that utilize screens that look like the option chains. So if we look at if we look at the option chains, many times investors will use chains that, when they're looking at a chain, it's hard to know exactly how much money am I going to make if the market does move significantly higher. So if I'm looking at index options like the OMX S30, when you're looking at an option chain, it's difficult for you to tell if the index moves 60 points higher, how much money do I make, right? So, and if you don't know how much money you're going to make, how can you plan accordingly to make sure that you're buying the right option and that the option suits your outlook on the underlying stock? That's why we created OptionsPlay, so that you can say, well, if the stock moves 60 points higher, how much money do I make? And if you come to the realization that I don't make any money, maybe you might say to yourself, this is not the right strategy for me. Maybe I want to trade another strategy. But on the same token, maybe you do think it's going to make a new high. Maybe you think it's going to hit 1800 right up here, around right here, make a new high and hit 1800. If that is the case, now things really look interesting, because if you had bought a future, you're looking about a 7% return, 7.5% return. If you bought a call option, you're looking at a very nice 92% return. But by reducing the risk of your trade from 6,700 crowns to 6,000 crowns, what you do is you amplify your returns now. Not only am I taking on less risk, but if the trade goes in my favor, I'm going to make a higher return. How did I make a higher return? I made a higher return simply because I risked less money. Again, you can't control how much money you can make, but you can control how much you risk. And by controlling the amount of money you risk and reducing it, you do increase your returns if you are correct on the underlying trade. So this is really how we can utilize options to our favor to get the payoff graphs that we're looking for. Now, I want to now show you what happens if you say to yourself, I don't think OMS S30 is going to get all the way up to 1800. I think that's a pretty far stretch, but I do think that I'm bullish, and I think it's going to move a little bit higher, but not that much higher. What can I do? Am I only better off trading the future? Or are there other strategies that I can trade if I think it's going to move a little bit higher, but not a whole lot? So that's really where we turn to credit spreads, what we learned in the second course. And this is really where we can use credit spreads that by selling a put option and collecting some credits and being able to profit from this type of strategy as long as OMX S30 stays where it is and doesn't move much lower. So if, let's say, you feel that this is a pretty solid support level, you're pretty sure that the markets aren't going to continue moving lower, especially as you believe that if you are in the same belief as I am, that central banks will continue to support the markets and that they will provide effectively unlimited liquidity in the markets, and they will continue to slowly grind asset prices higher. If you are in that camp, then you might want to take a look at selling a credit spread. So in the same scenario before, right? Let's say I just want to put on to understand what my risk is. So if I sold the credit spread and the market's tanked, my risk here is 4,700 crowns. So ask yourself, am I willing to risk 4,700 crowns? If you say yes, then this is a strategy worth looking at. If the answer is no, move on to the next strategy. You should not be looking at this if you are not willing to risk 4,700 crowns. So if you are, then we can start taking a look at, well, what happens if OMX S30 by August is still where it's currently trading, 1675. So let's say markets find an equilibrium. Maybe it moves a little higher, maybe it moves a little lower, but then it finds itself back up to around 1675. If you had bought a call or a call vertical, you're looking at almost a complete total loss of the premium that you've paid. Here you lost 92%, here you lost 92%. So both of these, you lose almost everything if the index does not move. But as you can see here, the credit spread on the right-hand side pays you if the market doesn't move. And this is the opposite, if you will, of the four strategies, right? Buying a call, buying a put requires a big move. When you're selling a call and selling a put, it requires the stock to not move, right? If the stock doesn't move, you actually make the most premium. So in this particular case, if the index doesn't move, you make 2250. So roughly 2,200 crowns in this particular case. If the markets move higher, you also make 2,200 crowns. And actually, no matter how high it goes, you're capped at 2,200 crowns. And that's the downside of selling option strategies, is that the upside is that if it doesn't move, you make money, which is not a strategy that you can say for any other type of strategy. But if it makes a big move, you don't make any more money. because if the index doesn't move to the $1,800 level, here you're still only making 2,200 crowns versus here you're making 6,900 crowns. And the two risks aren't that different. Here I'm risking 4,700 crowns, here I'm risking 6,000 crowns. It's a little bit more risk, but I am getting significantly higher returns if the market does move significantly higher. So that's the difference between selling a credit spread and buying a debit spread. I know that they are sometimes difficult to understand, especially at first, but this tool really allows you to put the two side by side and compare them using the P&L simulator and seeing how these strategies perform based on your expected outlook. So if you think that's going to go back to 1732, you're going to say to yourself, I'm much better off selling the credit spread rather than buying the call or buying a call vertical, which is not very apparent when you're just looking at a page that looks like this. It's impossible to compare a debit versus a credit spread by looking at the options chains. And that was the challenge that we had as traders before we started OptionsPlay, because we used to have to do these calculations in our head very quickly to get a sense for, are we better off buying or are we better off selling? And at best, it was an estimation. We didn't have the calculators to do this type of stuff side by side. We would have to set up a strategy, look at it, remember the P&Ls, then set up this strategy, look at it, and see in our heads which one is better. We created OptionsPlay so that you can compare any three strategies side by side. I do a lot of comparisons myself between debit versus credit spreads to try to see, where do I have an edge? Where do I think the markets are going to go? And then based on that, decide which one's actually best suited for me. And many times until I do the analysis, I really can't tell which one's better. And this is why we created this tool, so that you guys have access to this tool as well to be able to utilize this to make your own decisions. So that's just a quick review of where the current market stands, how we're currently utilizing these types of strategies to take a look at. And what I'll do at this point is I'll open this up for you guys to submit symbols that you want me to take a look at. So if you have any symbols that you want to take a look at, type them into the chat window. You can, please, if you're going to submit a symbol, also tell me whether you're bullish or bearish on that symbol. We'll take a look at those symbols together. Hopefully this will be a way to share some ideas with you guys. And you guys can see me analyze the symbols and show you how I would determine which one of these strategies I might trade in my portfolio. So please, if you have any symbols that you want me to take a look at, type them into the chat window. Just type in the symbol and type in whether you're bullish or bearish. And please keep these to the Nordic symbols. Okay, so here I have a request from here for ABB. So let's first take a look at ABB, and I'll show you some of the things that I look at to make a determination. First of all, there's a few things that I look at. I look at the technical score, which tells me relative strength. This is telling me whether a stock or ETF is underperforming or outperforming the current market. So a score of 7 tells me that it's outperforming the market. Notice how it's recently made a new high. So every single time it's managed to make a new high, new low, and is now making a new high. That's why it's outperforming the overall market. And the OMX S30 before I was showing you, the market itself did not make a new high. So not only did the strategy make a new high, 1 month and 6 month trends are bullish, so it continues to trend higher. This is the type of strategy that I'm looking for more of a bullish view here. Now, I will also point out from my eye, just a quick zooming out, what you have here is a bit of a, let's just call it a resistance level around 200, right? So it acted as resistance, broke out, and then came back to kind of retest this as support, and is now starting to move higher. So that's really, what that leads me to believe that 200 is a pretty solid support level here on ABB. Now, I don't know a whole lot about the fundamentals, and that's usually what I need to use to determine whether I think the stock is going to make a big and fast move or more of a slow move. I will say that the momentum, as you can see here on subsequent moves, has slowed down a little bit. So we had a pretty strong momentum push, slowed down, started to move a little higher, but you can see the pace at which it's moving is much slower than the pace here. So this is a much lower slope. So I do have some concerns as far as how high it can go, or at least how fast it can go. So I think the best thing to do here is compare a few different strategies side by side. So let's say I sell at 200, 215, something like that, in terms of a credit spread. And then let's look at buying a call option and buying a call spread here. So let's see. Here, the three strategies are actually risking roughly the same amount of capital. If I sold a credit spread, I'm risking 1,000 crowns. If I bought a call option, I'm risking 1,200 crowns. If I bought a vertical spread, a debit vertical spread, I'm risking 1,000 crowns. So the debit and the credit here are virtually the same in terms of risk. So first ask yourself, am I willing to risk 1,000 crowns on this trade? If the answer is no, this is not a strategy you should pursue or look at even any further. It doesn't matter what the potential gains are. It doesn't matter how much money you can potentially make. If you're not willing to risk $1,000, 1,000 crowns on this trade, you should walk away. That's the first lesson that I want to make sure every investor for options learns, okay? Once you determine this is the amount of risk that you're comfortable trading, then we can take a look at how much does the stock need to move and how much profit would I potentially get. So we talked about 200 being a fairly decent support level here. So let's just say the markets go back to 200, right? Let's say it reaches to 200. All of these strategies will have a loss here in this particular case if the strategy goes down to, I'm sorry, if the stock revisits 200, you're risking about 1,000 crowns across the board, all three strategies, right? So if you get the direction wrong, you're risking 1,000 crowns. If for whatever reason the stock stays around where it is, around 210 or so, here as you can see, selling the credit spread, I'm sorry, it's trading at 215. So if it's trading at around 215 by August expiration, you're looking at a 490 crown profit on the credit spread, a $700 loss on the call, a 500 crown loss on the call vertical here. So if you think the market's going to stay where it is, or if you think it's going to be a very slow, neutral move, sell the credit spread. If you feel that the markets can continue to rally, now, there are some, I would say you have a little bit of resistance here around 222 and 231. So at 222, as you can see, the call option is just breaking even. At 222, the vertical spread still only makes 200 crowns profit. So you can say to yourself, well, even if it reaches back to that 222 level, I'm still better off selling that credit spread. So if you think it's going to be between 215 and 222, sell the credit spread. If you think you can get up to 230, I think that's really where the calls and the call verticals will start to shine. Yeah. So if it moves up to 230, which is I would say, if you go back to the November highs, 230 was a pretty solid level here, right here, right? 230 was resistance, and a bit of support before it broke below that right before the sell-off during the coronavirus. So 230, I think, is a level that investors will remember from prior to the coronavirus. You certainly have a lot of buyers that bought below 230. So if they get up to 230, that could be a major resistance level where you have a lot of investors that bought up to 230 that would sell their investments and hopefully to get themselves back to break even. So 230, I think, could be a pretty solid resistance level. And as you can see, if that happens, you're looking at an 800 crown profit on the call, 1,000 crowns on the calls vertical here. So if you do think you can get back up to 230, that's really where the call or the call vertical starts to outshine the credit spread. And if anything further, you're going to see significant gains to the upside. Now, anything greater than 230, then you absolutely should be buying the call or the call spread. But I think 230 should be your target to consider these two strategies over the credit spread, okay? So that's how you would analyze a stock, that's how you would analyze the levels, and that's how you could set up the strategies side by side to look at which ones might be most suited for you. Mika wanted to take a look at EQT. Again, if you have any other symbols that you want me to take a look at, please type them into the chat window alongside whether you're bullish or bearish on that symbol. EQT. Now, I don't know a whole lot about this particular stock, but the first thing I did notice is the fact that you have this fairly major level at 160. 160 was a double top here back in February and March. It was a top here multiple times, broke out above, and then really kind of skirted around this 160 level, and it's found a bit of an equilibrium here around 160 and has started to move a little bit higher now. So the question is whether this can continue to move higher. But from a chart setup perspective, I certainly would put this more in the bullish camp. Now, this is a stock that hasn't been trading for very long, which is why we don't have a relative strength and we don't have a 6-month trend calculated for this yet. But just based on that chart action alone, I would certainly put this more into the bullish category than the bearish category. So I agree with your analysis, Mika, yeah, on the strategy. So if you were to buy 100 shares of the stock, and maybe I'll switch this to a credit spread instead. So let's look at a credit spread trading at 165. So maybe I'll sell the 165, buy the 150s or the 145s, something along these lines. As you can see, most of these are risking roughly the same amount of capital here, 1,300 crowns, 1,300 crowns, 1,100 crowns. So roughly 1,100 to 1,300 crowns. Again, first question you should ask yourself, am I comfortable taking on that type of risk? Because you are risking losing all of that in this single trade. And the question is, can you afford to lose 1,000 crowns on a single trade? If the answer is yes, then let's start exploring further. If the answer is no, walk away. Move on to another trade. Maybe find a trade on a lower price stock if that is the case. So if you are willing to risk that, then let's take a look at these strategies here. So as I said, 160 is a major support level. I would expect that it would stay around 160, from my perspective, that it would stay above 160. If it stays at 160, the credit spread will collect a little bit of profit, not a whole lot, but it's still some profit here. And this is what's I find interesting about credit spreads for most investors, is that you can sell a credit spread, get the direction wrong, because here the stock actually declined 5 crowns here, right? You can get the direction wrong and still make a profit. That is the forgivingness, if you will, of a credit spread. The downside to a credit spread is that if you're wrong, you're risking roughly double what you can potentially make on the trade. So that's a downside to a credit spread. But if, let's say, the stock stays where it is, you're collecting roughly 670 crowns versus losing 1,200 and 1,000 crowns on the call or the call spread. And then you can say to yourself, how far do I think the stock can go? Now, this stock doesn't have a lot of history. So the last high was at 182. So even if the stock revisits that 182 high, you're still looking at a higher profit on the credit spread than you do on any of the other two strategies. But the debit spread is getting close. The debit spread is at 600 crown profit versus this is 670 crown profit. And you are risking a little less on the debit spread here, 1,100 crowns versus 1,300 crowns. So if you think that it's going to revisit back to its all-time highs, the credit spread and the debit spread, relatively similar, not a big difference between the two. So the question really just believes, do you believe in this company fundamentally? Do you agree? Do you believe in this stock long term, that you do think that it's going to make a new all-time high? If you think it can make a new all-time high and push into the 190s, now the debit spread really makes a lot more sense. So I don't know a whole lot about this particular stock. I think you guys probably know more about it than I do, but that kind of then sways into your personal views on the stock. And that will help you determine whether you should sell a credit spread or buy that debit spread. So I hope that that was helpful in helping you set that up. Let's take a look at this BOL. I looked at this the other day. Now, this chart looks much similar to the OMX S30, and notice the technical score here is 4. So much more in line with the market. It is starting to push a little bit higher, but it's still fairly neutral. It really depends on how bullish you are on this particular stock, but I would be taking, I think my preference would be more on the selling options here rather than buying, because I do think that this is more neutral. Unless you have a different view and you think that this stock can really make a big move to the upside, my preference is to look at more selling strategies here and take a look at how much risk you're taking. As you can see here, roughly the three strategies roughly risk the same amount, roughly 1,200 to 1,400 crowns. And then you can, based on the analysis that we've been doing so far, you can take a look at, well, if the markets do plummet back down to 180, how much are you putting at risk? Like we said, the three are risking roughly the same. If it stays the same price, roughly how much collect, how much income can you collect off of the credit spread. But if it does take off, right, if it reaches up to 230 or more, how much can you actually make on that call option or the call spread? So even at 230, right, 230, which is all the way up here, 230 goes back to a level that is, I would say, somewhat significant, right? Because you have some support here, some resistance there. So 230, I think, would be a reasonable target to the upside. Even if you get to that level, the credit spread is still roughly in line with what you would expect here on the call or the vertical spread. So again, my preference, I think, would be to sell that credit spread, because you would really need a move above 230 back into the 240s before these strategies start to make more sense. So that's my view here. But if you're bearish, then what you can do is you can take a look at selling some credit spreads. Again, you would take a look at a bearish credit spread here. So maybe you would sell a 215, 230, maybe something along these lines. Notice how on a credit spread here, you're actually risking the least amount of capital, right? So here I'm risking 13, here I'm risking 1100, here I'm risking 850. So this credit is actually receiving a pretty sizable credit. This is a 15-point wide credit spread. You're collecting 650, which is almost 40%, a little more than 40% of the width. That is a pretty hefty income that you're receiving, which is significantly reducing your risk here. So in this particular case, if you do think it's going to revisit maybe 185 or so, which is a pretty big target to the downside, as you can see here, that's really where the debit spread shines, almost 3 to 1. Here you're making 1,900 crowns. Here you're making only 650 crowns. Your risk is a little higher here, but not by a whole lot, but you're potentially making a lot more money. So it really depends on how much lower you think BOL can go. If you think it's just going to stay around its equilibrium state around 200 or so, maybe 205, 203, notice how here, if it does stay within that range, you certainly make more money on the credit spread. But if you do think it's going to move to the downside, you're going to get significantly better returns on that debit spread. Okay, so we have time for one more. Let's take a look at. I think I've already looked at one from. Let's see. Let's take a look at NDA. Nordea Bank. You want to look at the Swedish one. And you're bearish here on Nordea. So a lot of the banks have very similar looking charts here. It does look like it's on the verge of a potential breakdown here. So you have this resistance level now testing as support. I think a lot of investors are currently concerned that the banks look fairly weak and they're going to continue moving lower. If it breaks below that level, you can get a pretty nice sizable move to the downside. So I think a lot of investors feel the same way. It is something to consider. As you can see here, I'm risking only 165 crowns to potentially make 135. So one of the things you can adjust is the amount of capital that you're willing to risk. So let's say you're willing to risk 1,000 crowns. What you can do is you can adjust the number of contracts. So you're roughly comparing apples to apples here and seeing how these strategies will perform side by side. And you can see that if it revisits, let's say it stays where it is around 63, 64, that's again where the credit spread shines, right? So if it doesn't move below that support level, you're better off selling that credit spread. But if you do get a move back down to even 58, I'm sure here, if you move that down to 58, yep. Well, actually, here, you get roughly the same amount of return here, across the board. Remember, we're risking roughly the same amount here, roughly a little under 1,000 crowns here. But here I'm making 810, here I'm making 720. Not a huge difference here. I am risking substantially less. So I probably would take this strategy here on the right, because this I'm only risking 680, here I'm risking 1,000 crowns. I'd rather make 720 crowns off of 680 than make 810 off of 990. The returns here aren't as great. So that's how I'm viewing this current trade. But if you do get a move further to the downside, that's really when these strategies starts to outperform. So that's just a quick review of how you think about analyzing the markets, regardless of whether you're bullish or bearish in the markets, how you can take what you've learned over the past few weeks on debit versus credit spreads and see how you can get these types of directional moves in a way with limited risk. And the key here is that in all of the examples that we gave you, no matter what happens, even if the world ends, even if we get a vaccine tomorrow and all equity markets start to rally significantly, no matter what the downside exposure you have, all of the strategies that we talked about today roughly risk about 1,000 crowns per contract. So you can use that to help you frame your views, because if you traded the stock, you're certainly risking a lot more than 1,000 crowns if you have some kind of black swan event that you couldn't anticipate ahead of time. The reason that we use options, or that I use options in my portfolio, is not necessarily because I think I can make more money trading options, but more importantly is because I can control my risk better when I'm trading options. And today, what I'm hopefully to show you is the different option strategies that you can utilize depending on your different outlook. Some of you think it's going to go higher. Some of you think it's going to go lower. Some of you think it's going to make a big move. Other of you think it's going to make a small move. There are option strategies for all of these different scenarios. It's just important that you know how to analyze them, know how to set them up, and know how to compare them so that you're actually trading the strategy that is most efficient and most suitable for your outlook. So I hope that today's session was helpful in giving you a better understanding as to how to think about these option strategies, how to set them up within OptionsPlay so that you can really compare them side by side and get a better understanding as to which strategy is best suited for your particular outlook, regardless of what stock or ETF you want to take a look. So OptionsPlay is available to everyone free of charge. You just have to sign up using the link here on your screen at optionsplay.se. So if you're a first-time user, if you haven't seen OptionsPlay before, first of all, welcome. I hope that this inspired you to take a look at OptionsPlay because it is designed to help you make your options trading a lot easier. We make this so that you can have a better understanding as to how to trade options. So with that, I want to thank her for taking the time out here this evening. I hope that this was useful. And at this point, what I'll do is I'll open this up for questions if you guys have any questions that I can address regarding the OptionsPlay platform. So thank you so much for your time. Nicholas, you're very welcome. It looks like there was a question. How to use the standard deviation scheme in OptionsPlay, meaning the red and so the question was really, how do you use the red and the green? Because the red and the green automatically defaults to a 1 standard deviation move. So the red and green just shows you that if the stock stays within the expected normal range based on standard deviations, how much profit and loss should you generally expect? Now, we actually do the calculations for you because, as you can see here on this particular chart, I have relatively small amount of green with a lot of red. And that type of risk to reward is not great. And that's why you have a lower OptionsPlay score. Versus here, I have a larger amount of green or potential reward and a smaller potential amount of red, which is potential risk. It's because you can't just look at the amount, you also have to look at the probability. And that's why we created the OptionsPlay score. The OptionsPlay score gives you an idea as far as how well balanced the potential reward is to the potential risk. Wolfgang is asking, what would be a good size of account to start trading options as a beginner? So as you notice that, most of the trades that we looked at today, your minimum risk